If you're a senior receiving Social Security, or you're getting close to filing for it, there's a set of rule changes that took effect this year that a surprising number of people still don't fully understand. And by the time most people find out, they've already missed out on money they were owed or made a claiming decision they can't take back. So in the next few minutes, we're going to walk through exactly what changed, why it changed, and what you should actually do about it. And everything in this video is based on publicly available information from the Social Security Administration and recent reporting, not speculation. So let's get into it. The biggest and most financially significant change involves something called the Social Security Fairness Act, which was signed into law in January of 2025. And while that might sound like old news, the effects of this law are still working their way through the system right now in 2026. And millions of people affected by it still haven't received everything they're owed. Here's the background. For decades, two provisions known as the Windfall Elimination Provision, often shortened to WEP, and the Government Pension Offset, often shortened to GPO, reduced Social Security benefits for people who also received a pension from a job that did not pay into Social Security. This mainly affected teachers, firefighters, police officers, and other state and local government employees. Along with their spouses and surviving spouses, in some cases, these provisions cut monthly benefits by hundreds of dollars. And for surviving spouses specifically, the government pension offset could reduce a survivor benefit all the way down to nothing. The Social Security Fairness Act eliminated both of these provisions entirely, which means if you worked in public service and earned a pension from a job that didn't pay into Social Security, or if you're the spouse or surviving spouse of someone who did, your Social Security benefit may now be significantly higher than it was before. And this isn't just about future payments either. The law included retroactive payments going back to January of 2024. So many affected beneficiaries received a lump sum payment covering that back pay, along with an increased ongoing monthly benefit. Now here's the part that most people don't realize, and this is genuinely important. Not everyone who's owed money under this law has received the full amount. Some beneficiaries, particularly surviving or divorced spouses of public sector workers, have only received about 6 months of retroactive back pay instead of the full year they may be entitled to, based on how the Social Security Administration initially interpreted and processed the law. This discrepancy got enough attention that a group of senators sent a formal letter to the Social Security Administration asking for a review of the agency's policy on this specific issue. So if you are a surviving spouse or a divorced spouse of someone who worked in a public sector job affected by these old rules, and you haven't seen a full retroactive adjustment on your account, this is worth calling the Social Security Administration about directly. You can reach them by phone, through their website, or in person at a local office, and you should specifically ask whether your retroactive payment reflects the full eligible period back to January 2024. Don't assume the math was done correctly on your account just because you received some payment. It's worth double-checking. Moving on to the second major change. And this one affects essentially everyone, not just public sector retirees. Full retirement age has now officially reached 67 for anyone born in 1960 or later. This has actually been a gradual, decades-long phase-in that started with legislation passed back in the 1980s. When full retirement age was originally 65. But 2026 marks the year this phase-in is finally complete. So what does full retirement age actually mean for you? It's the age at which you become eligible to receive 100% of your calculated Social Security benefit. With no reduction, you can still choose to start collecting benefits earlier, as early as age 62. But doing so permanently reduces your monthly benefit. And we do mean permanently. If you claim at 62 instead of waiting until your full retirement age of 67, your monthly benefit is reduced by roughly 30% for the rest of your life. That's not a temporary penalty that goes away later. It's baked into your benefit calculation permanently. On the flip side, if you're able to wait past your full retirement age, your benefit actually continues to grow by about 8% for each year you delay, up until age 70, after which there's no additional benefit to waiting further. So the practical takeaway here is that the age you choose to start collecting Social Security is one of the most consequential financial decisions many retirees make. And it's not a decision that should be made casually or based on what a friend or relative did. Because everyone's health, other income, and financial situation are different. If you're unsure whether to claim early, at full retirement age, or later, it's worth using the Social Security Administration's own online calculators. Or speaking with a financial advisor who can look at your specific numbers, rather than guessing. Next, let's talk about the annual cost of living adjustment, often called the COLA, which increased benefits by 2.8% starting with January 2026 payments. This was slightly higher than the 2.5% increase that took effect the year before. And for the average retired worker, this translated to roughly an extra $55 to $56 per month. Which sounds like decent news on its own, but here's the detail that catches a lot of people off guard: Medicare Part B premiums, which for most beneficiaries are automatically deducted directly from their Social Security check, also increased significantly this year, rising to $202.90 per month for 2026, up from $185 the year before, which is roughly an 11 to 12% jump depending on how it's calculated. So if you're someone whose Medicare Part B premium comes straight out of your Social Security payment, a meaningful chunk of that cost of living increase may already be absorbed by the higher premium before the money ever reaches your bank account. This is worth knowing so you're not caught off guard when your net deposit doesn't feel as different as the headline percentage suggested it would. Next, for anyone who is still working while also collecting Social Security benefits before reaching full retirement age, there's something called the earnings test that's worth understanding. If you're under your full retirement age for the entire year, you can now earn up to $24,480 in 2026 before it starts affecting your benefit, which is up from $23,400 the year before, once you earn more than that limit. Social Security withholds $1 in benefits for every $2 you earn above that threshold. However, in the specific calendar year, you actually reach full retirement age. A different and more generous limit applies. For 2026, that limit is $65,160, and above that amount, the withholding is less severe. $1 withheld for every $3 earned above the limit, once you actually reach full retirement age. This earnings test disappears entirely, and you can earn any amount without any reduction to your Social Security benefit. One important thing to understand about this earnings test is that the money isn't necessarily lost forever. When you reach full retirement age, Social Security recalculates your benefit going forward to essentially credit you back for months where benefits were withheld due to this test. So if you're working while collecting early benefits and you see reductions happening, it isn't necessarily gone permanently, but it can absolutely create confusion and unexpected changes to a monthly check if you're not expecting it, which is exactly the kind of thing that trips people up if nobody explains it clearly in advance. Next, there's a change relevant to higher earners still in the workforce. The maximum amount of income subject to Social Security payroll tax, sometimes called the taxable maximum or wage base, increased to $184,500 for 2026, up from $176,100 the year before. That's an increase of $8,400, which means higher income workers are paying Social Security tax on a larger portion of their earnings than they were the previous year. For someone earning above that new cap, this can mean paying several $100s more in Social Security taxes for the year. And because employers match that contribution, the combined impact on total contributions into the system is roughly double that individual amount. This change doesn't directly affect people who are already retired and collecting benefits, but it's relevant if you're still working, especially if you're a higher earner planning your final working years before claiming Social Security. Next, let's talk about a change that's specifically relevant to how seniors are taxed. Separate from Social Security rules themselves, but closely connected to retirement income planning, a new tax law enacted in the summer of 2025 created an additional deduction specifically for taxpayers aged 65 and older. For tax years 2025 through 2028, eligible seniors may claim an additional $6,000 deduction, or $12,000 for married couples filing jointly where both spouses qualify. And this is on top of the existing additional standard deduction that's already available to seniors under prior tax law. This deduction can lower the amount of your income that's subject to tax, which for some seniors may also reduce how much of their Social Security benefit ends up being taxable, since Social Security taxation depends partly on your overall taxable income. If you're 65 or older, it's worth making sure whoever prepares your taxes, whether that's yourself, a paid preparer, or a free program like the AARP Foundation, tax aid service available at many libraries and community centers, is aware of this deduction and applying it correctly. Next, here's a change that's more about the mechanics of how payments actually reach you rather than how much you receive. The Social Security Administration has been moving toward a fully digital, direct deposit-based payment system, following an executive order requiring nearly all Social Security and Supplemental Security income beneficiaries to receive their payments electronically rather than through paper checks. By around the middle of 2026, this transition is expected to be essentially complete. There are limited exceptions carved out for certain beneficiaries, including some individuals with severe disabilities or those living in areas without reasonable access to banking services. But the overwhelming majority of beneficiaries are expected to be on electronic payments at this point. If you are someone who has continued receiving a paper check, it's worth proactively setting up direct deposit or enrolling in the Direct Express prepaid debit card program sooner rather than later, rather than waiting to be told you have no choice, because paper checks are generally described as far more vulnerable to theft, loss, or delay compared to electronic payments. And you don't want to find out your check didn't arrive because of a processing backlog tied to this transition. Related to this modernization effort, the Social Security Administration has also expanded its use of a system that verifies income and resource information more directly with financial institutions and payroll data providers. This is particularly relevant for people receiving supplemental security income, since that program has income and resource limits that determine eligibility, and the agency is now able to verify bank account and wage information more efficiently in many cases, which can reduce the burden of having to manually report certain income changes yourself, though it also means it's more important than ever to make sure the agency has accurate, up-to-date information about your accounts and any authorized data sharing permissions, if this applies to you. Checking your details through your online My Social Security account is a reasonable way to confirm everything on file is accurate. Now, it's worth pausing here to address something you may have seen circulating more broadly. There has been considerable public discussion this year about the long-term financial health of the Social Security Trust Fund itself, and this is a legitimately important, ongoing policy conversation. But it's also an area where a lot of alarming or oversimplified claims circulate online. So let's stick to what's actually documented, based on the most recent official trustees' report. The Social Security Trust Fund is projected to face a shortfall in the early 2030s if no legislative changes are made before then. And some recent budget projections suggest that timeline may be moving slightly earlier rather than later. This does not mean Social Security is going to disappear or stop paying benefits entirely. Even under a worst-case scenario, where no legislative action is taken before the trust fund's projected depletion date, the program would still be able to pay a substantial majority of scheduled benefits using ongoing payroll tax revenue, though that would represent a real reduction from currently scheduled amounts, historically. Congress has acted before previous projected shortfall dates to adjust the program in various ways, and there is active policy discussion happening right now, including proposals related to how high-income benefits are calculated. But as of today, no such structural change affecting a benefit cap or reduction of that kind has been enacted into law. So it's important to separate proposals and policy debates, which get a lot of attention in the news and on social media, from changes that have actually been signed into law and are currently in effect. This video has focused specifically on the latter. So, bringing this all together, here's a practical checklist based on everything we've covered. If you or your spouse worked in a public sector job with a pension that didn't pay into Social Security, check whether you're receiving the full benefit you're now entitled to under the Social Security Fairness Act. And if you're a surviving or divorced spouse specifically, verify your retroactive payment covers the full period back to January 2024. If you haven't started collecting Social Security yet, understand that full retirement age is now 67 if you were born in 1960 or later, and think carefully about the trade-offs of claiming early versus waiting. Since that decision permanently affects your monthly benefit, if you're still working while collecting benefits before full retirement age, know your specific earnings limit for this year, and understand that any withheld benefits get factored back into your benefit calculation once you reach full retirement age. If you're 65 or older, make sure your tax preparation accounts for the new additional senior deduction available for tax years 2025 through 2028. If you're still receiving a paper Social Security check, consider proactively switching to direct deposit or the Direct Express card program before the transition affects you unexpectedly. And generally, make it a habit to check your information through your own online Social Security account periodically, rather than relying only on mailed notices or things you've heard secondhand. The Social Security Administration's official website is the most reliable source for your specific numbers. And for anything involving your individual benefit calculation, retroactive payments, or eligibility, it's always worth contacting the Social Security Administration directly or speaking with a qualified financial advisor who can review your personal situation, rather than relying solely on general information from any single video, including this one. We hope this breakdown helped clarify what's actually changed this year, separate from rumors or oversimplified headlines. And if you found this useful, share it with a friend or family member who's navigating these same decisions, since so many people genuinely don't find out about some of these details until it's too late to fully benefit from them. Thanks for watching, and take care of yourselves. And before we fully wrap up, let's spend a little more time on a few of these points, because some of them deserve more context than a quick summary can really give, starting with the Social Security Fairness Act. Since this is genuinely the single biggest change affecting benefit amounts for millions of people right now, to understand why this law mattered so much, it helps to understand what the old rules were actually trying to do, and why they ended up frustrating so many public sector workers for so long. The windfall elimination provision was originally designed to prevent a specific kind of double benefit, since Social Security's formula is intentionally generous to lower lifetime earners. Someone who worked only a handful of years in a Social Security-covered job and spent the rest of their career in a public sector job with its own separate pension could end up looking like a low lifetime earner in Social Security's formula, even though they weren't actually low income overall once you counted their pension. The windfall elimination provision adjusted the Social Security benefit formula for these workers to correct for that, but in practice, many people felt it was applied too broadly and penalized workers unfairly, sometimes cutting their earned Social Security benefit by hundreds of dollars a month. The government pension offset worked a bit differently, targeting spousal and survivor benefits specifically, reducing those benefits for people who also received a government pension from non-covered work. And in some cases, this offset was large enough to reduce a spousal or survivor benefit all the way down to zero, meaning some surviving spouses of long-serving public employees received no survivor benefit at all, despite decades of marriage. This created real hardship for a lot of retired teachers, firefighters, and police officers, and became one of the most consistently criticized aspects of Social Security policy for years, which is part of why its repeal generated so much attention when it finally passed. If this applies to you or someone in your family, it's worth taking a few concrete steps. First, log into your own personal My Social Security account on the official SSA Gov website and review your current benefit amount and payment history. Second, if you believe you're owed retroactive payments and haven't seen them reflected, call the Social Security Administration directly. Wait times can be long, so calling early in the morning when phone lines open, or visiting a local field office in person, may get you a faster resolution than trying repeatedly online. Third, keep any letters or notices you receive from the agency about this specific issue, since having documentation on hand can make a follow-up conversation faster if there's ever a discrepancy to resolve. Now, let's go a bit deeper on the full retirement age change as well. because the financial impact of claiming decisions is honestly larger than most people initially realize. When we say claiming at 62 reduces your benefit by roughly 30% compared to your full retirement age benefit, that's not a one-time adjustment. It's a permanent reduction applied to every single monthly payment for the rest of your life. And since many retirees live into their 80s or beyond, that reduction compounds into a very large total difference over the full span of retirement. On the other hand, delaying benefits past full retirement age increases your monthly payment by roughly 8% for each full year you wait, up until age 70, and unlike some other financial products, this increase is essentially locked in and guaranteed once you start collecting at that later age, which is part of why many financial planners describe delaying Social Security, when it's financially feasible to do so, as one of the more reliable ways to increase guaranteed lifetime retirement income, of course. This isn't the right choice for everyone. If you have significant health concerns that make a shorter lifespan more likely, or if you genuinely need the income sooner to cover essential expenses, claiming earlier may make more practical sense despite the permanent reduction. This is exactly the kind of decision where personalized guidance matters far more than a general rule of thumb. And the Social Security Administration's own website includes benefit calculators that let you estimate your payments at different claiming ages using your actual earnings record, which is a good starting point before making a final decision. Let's also spend a bit more time on the earnings test, since this trips up a surprising number of people who return to part-time work after initially retiring, or who never fully stopped working in the first place. Remember that this earnings test only applies if you're collecting benefits before you've reached your full retirement age. Once you're at full retirement age, you can earn any amount of income from work with absolutely no reduction to your Social Security benefit. So if you're already at or past full retirement age and someone tells you that working will reduce your Social Security check, that's outdated or simply incorrect information. If you are under full retirement age and collecting benefits, and you're not sure whether your expected earnings for the year will cross the relevant threshold, it's worth proactively reporting your estimated annual earnings to the Social Security Administration, rather than being surprised later when they recalculate based on your actual reported wages. This can help avoid a situation where too much or too little was withheld throughout the year, creating either an unexpected repayment request or a lump sum adjustment later. One more detail worth mentioning on Medicare, since it's so closely tied to what actually lands in your bank account each month. Beyond the standard Part B premium increase we already covered, some higher-income beneficiaries pay an additional amount on top of the standard premium, sometimes called an income-related monthly adjustment, and this amount is based on income reported on your tax return from 2 years prior, so if your income has changed significantly since then, for example due to retirement or a change in investment income, it's worth knowing that you can request a reconsideration of this adjustment with the Social Security Administration if your circumstances have changed, rather than assuming the higher premium is fixed regardless of your current situation. Finally, on the subject of scams, since this is worth mentioning any time we're discussing Social Security changes, scammers frequently take advantage of confusion around legitimate rule changes like the ones covered in this video, by pretending to be Social Security representatives and asking for personal information, payment, or remote access to your computer or bank account in order to process a supposed benefit increase or retroactive payment. The Social Security Administration will never call and demand immediate payment. Ask for payment by gift card, wire transfer, or cryptocurrency. Or threaten immediate arrest for a problem with your benefits. If you receive a call, text, or email like this, the safest response is to hang up or not respond, and instead contact the Social Security Administration directly using the official phone number listed on SSA. Gov. To verify whether there's actually anything you need to do. To summarize everything one more time in practical terms, verify your benefit reflects the Social Security Fairness Act if it applies to you. Understand that full retirement age is now 67, and think through your claiming strategy carefully before filing. Know your earnings limit if you're working while collecting early benefits. Make sure your tax preparation includes the new senior deduction if you're 65 or older. Transition to direct deposit or Direct Express if you're still receiving paper checks. Stay alert to scams that exploit confusion around all of these changes. And whenever you're uncertain about anything specific to your own account, go directly to your official My Social Security account online or contact the agency directly, rather than relying on second-hand information, even well-intentioned information like what's covered in this video. Thank you again for watching all the way through. We hope this gave you a clear, accurate picture of what's actually changed this year, and we hope it helps you make more informed decisions about your own retirement income. Take care of yourselves, and we'll see you in the next one.